This is a presentation on building a business case, also known as capital budgeting in the world of finance. If you are requesting a fair sum of money from the finance folks, they're going to ask three questions. How much money is the project going to make us? What's the project's rate of return? And how long till we recoup our initial investment? Of course, in finance speak, this is net present value, IRR, and payback. So those are the three criteria that we're going to focus on so that you know how your projects are being evaluated or your proposals are being evaluated objectively and quantitatively. So let's say you approach finance team with a request for $165,000 and they believe your forecast of $63,000, $71,000, and $91,000 over the following 3 years. First thing that they're going to do is they're going to assign a required rate of return to that. And the reason is because they're going to be comparing your projects against other proposals, first of all, and there might be different risks. And also, the $165,000 has to come from somewhere, and it comes from various sources of financing, and the sources of financing cost money. And so I'm just making up the 12% in this case. Your particular project might be higher or lower depending upon the cost of funding for the firm. So the 12% is going to end up being important because that's the hurdle rate against which your project will be judged. So we need to answer the three questions. Payback refers to how long it takes for the project's initial cash flows to be earned back. So you can see, you can kind of eyeball it and say, well, you spend $165,000 in the first year, you get back 63, that's not going to do it. You get back 70,000, you're not going to be there yet. That sometime during that third year, you're going to recoup the entire 165. And so if we wanted to figure out what that is formally, when we add the 63,120 to our original 165 outflow, we end up with still needing, at the end of the first year, $101,880. In the second year, we're going to earn a good chunk of that, but we're still going to be short if we're keeping an accumulated number, $31,080. So, sorry, this should be, we're going to still be short $31,000. And again, you can see during that third year, you're going to earn that $31,000 back and then some. And so, roughly speaking, about a third of the way through, you'll be there. So payback in this case takes you 1 year, 2 years, and about a third of the way through that third year. And if we want to do a specific calculation, we interpolate and divide 31 by 91 and get 0.34. So payback is 2.34 years. So you can see some of the merits of payback. Pros. Some of the pros are it's pretty simple to calculate and understand. It's pretty commonly used and employed. It also gives you a good measure of liquidity for the project. Like I said, it's pretty common, so other people have heard of it. I should read pros. Some of the cons. I don't know if 2.3 years is good or bad by itself. Of course, if we have some experience, then we'll have some guidelines that we might use. But by itself, 2.3 years doesn't mean anything to me. For example, 2.3 years might not be good for a high-tech project in a country that has a fair degree of uncertainty, political uncertainty to it. Most projects there, you would probably want your money back within a year or a year and a half. But a project in the utilities industry, for example, where you're running lines or pipes or wires into a development, and you're going to get paid over a period of 30 or 40 years, a payback of 10 years might be really good. And so we don't really have a specific benchmark, at least by itself. Another drawback is it doesn't consider the cost of the money, the 12% required rate of return. And in that instance, we don't really know if this is good or not good. It doesn't say anything about whether we're creating value or not creating value, or whether we're making enough money back to recoup the project's costs as well as the cost of financing. Another drawback is that payback by itself doesn't consider the cash flows beyond the payback year. So say, for example, I added year 4 and a cash flow of $1 million, payback doesn't change at all. So it's kind of odd that even a $1 million inflow doesn't influence a figure of merit. Or it could be a cost of $1 million afterwards, and that would also not be considered. So it's a key consideration that is missing. So, but besides that, payback's a simple, easy measure, and it's not normally used by itself, but it's used in conjunction with the other methods that we're going to see. So the second one, we learned that the project is going to pay itself back in 2.3 years, but it doesn't say anything about how much money we're going to make. That's what net present value says. So in this case, we do a quick cost-benefit analysis, and we see that the project makes $60,000 more than we spend. That's just we added up the flows. But the problem with that is that we haven't incorporated the 12% opportunity cost of the funding. So, for example, let's say you receive the inflows 100 years from now, you'd still get a positive $60,000, but clearly that wouldn't be a viable project to do. So we need to adjust for the timing of the cash flows. To do that, we ultimately find the present value of each of them before we add them up. So here we've done that. So to find the present value of the first flow, it's already at year 0, so we don't have to do anything with it. The year 1 flow, we pull back in time 1 year at a discount rate of 12%, find the present value, and get $56,000. Again, we can use our financial calculators to do this. We can use algebra to do this. We can use Excel to do this. Find the present value of year 2 flow, present value of year 3 flow. Now we add them up. What does this mean? That the project is expected to create value of around $12,000 in today's dollars. So of course it's going to be less than a nominal amount because we're using the present value, which is going to be a little lower. So how you want to think about this is, remember that the cost of funding is 12%. So what we're actually saying is that this project pays our owners back what we owe them and has $12,627 left over afterwards. So it not only overcomes the cost of funding, but it creates value in excess of it. So you can see right away, it incorporates the 12%. It incorporates all the cash flows. it gives us a natural benchmark. The natural benchmark is 0. That is, if we have a positive NPV, the project creates value. If we have a negative NPV, then the project is not expected to create value. So it looks like a pretty good criteria that we want to incorporate into our project analysis toolkit. So far we've got payback, we've got NPV, and the third most common one is the project's IRR. And in this case, it's measuring the average annual rate of return that the project's cash flows are expected to throw off. It's very, very simple to calculate IRR using your financial calculator or using Excel's IRR function. Just hit equals IRR, highlight the cash flows in the cells, and you're done. And you do that, you'll get 16.1%. Well, what does that mean? How do we get that? Essentially, we're setting up some algebra. We're setting up some algebra that says we're spending $165,000. We're expected to get $63,120 1 year from now. We're expected to get $70,800 2 years from now. And we're expected to get $91,080 3 years from now. What rate of return can we plug in there to make this equality hold? In other words, so that our benefits in a present value sense calibrate against our initial investment. And that ultimately is how we arrive at 16.1%. Intuitively, it's kind of simple if we look at an easier project. Let's say we have a different project, $100,000 initial cost, and that project is expected to provide us with $120,000 a year from today. Well, we can just eyeball that and see that this project's rate of return is 20%. That's what we're going to be earning for that year. If we set up the algebra, we can see how this works out. Our initial investment is on the left. Our inflow is on the right. And we're solving for the discount rate, if you will, that calibrates those two things together. And the only number we can put in there to make this equality hold is 20%. So that ends up being the way that we solve for the project's IRR. So now what have we got? We've got a project with a payback of 2.3 years, NPV of 12,627, and an IRR of 16.1%. We haven't really talked about whether the 16.1% for the IRR is good or bad. So what we would need to do is understand that we compare it against the cost of the money. If we're borrowing and the money costs us 12% and we invested in a project that earns 16, then that's positive for the project. So if the IRR is greater than cost of funding, then the project is expected to create value. And of course, if the IRR is less than the cost of funding, then it's not. So in this case, we've got two criteria that support the notion that the project's going to create value. And we've got one that says that it looks like the project's liquidity is going to be okay. So our ultimate decision would be to move forward with the project. It's expected to create value. Of course, this is looking at the project by itself. If we had other projects to compare it against, we have a method against which to do that. So the next question that we're going to address is where these cash flows come from. They're not the project's earnings. They represent the specific cash flows that the project is expected to either spend or generate over time. So in order to map those out, we can think about the types of projects that we can use these tools with. New product or service introduction, improving a process or an idea for cost savings, purchasing pieces of companies or companies themselves, retooling, setting bid price, implementing different systems. You can all think of these as normally you would expend resources at the front end in order to achieve some benefit later. And so we have to figure out the cash flows that we want to incorporate in our analysis. Most of them are fairly straightforward. What's it going to cost to get the project up and running? Is the project going to have any specific revenue impact or cost impact? Is it going to have a reduction in cost? These things are relatively straightforward, and we're kind of used to seeing them. The other things that we want to consider are other project side effects. So for example, if we're going to be using an empty part of or an empty building that we already own, does that have an opportunity cost associated with it? In other words, could we rent the building out if we didn't move forward with this project? If so, then that's an opportunity cost that we need to map or include. Does this project have other side effects, either positive or negative? So if we introduce this product, is it going to erode revenue from an existing product? If so, we want to understand what that is. It could work the other way. If we introduce this product, does it help companion products that our customers will buy? So introducing or increased revenue from iPhones might also improve sales of iTunes, for example. So in economics terms, these might be things like complements and substitutes that we want to understand that economic impact. Notice it doesn't have an accounting impact, so in other words, it wouldn't necessarily appear on our income statement, but it does have a forecasted cash flow impact that we want to consider. Also, does it have any cash flow impact on our working capital? Do we need to hold more inventory, for example? Does it change the notion of our accounts receivables or payables? And then finally, is there a tax impact? Taxes are cash, so we want to understand the tax impact. Some things that we don't want to put into our analysis. Depreciation is a non-cash expense, so we don't want to put it in. But we do want to estimate the tax impact of depreciation because it reduces our tax expense because it is an accounting cost. How about sunk costs? This is money that's already out the door. We don't want to incorporate sunk costs into our analysis. For example, if last year we spent $1 million on product development, this year, time period 0, it's going to cost us $500,000 to bring the product to market. And the project is expected to only bring in $800,000. Well, you can see that this is a loser. It's not going to achieve the level of profitability that we need. But today, what's the decision? Do we spend $500,000 to earn back $800,000? And so the $1 million is already out the door. And certainly, if we spent the $500 to make the $800, we would lose less money. So in other words, if we didn't do it, we would lose the $1 million. If we did do it, well, we'd still lose the $1 million. We'd spend the $500 to get the thing to market. We'd earn back $8, so the total would be, we'd end up losing $700,000. So you can see that the $1 million doesn't come into play in our decision of whether or not incrementally it's worthwhile to make the call today to bring it to market. In the ex post evaluation of the entire project, we would try to figure out what went wrong. So sunk costs, depreciation, we don't want to embed those in our forecasts. How about financing flows? I'm crossing them off because you don't want to put the interest costs, for example, that's a financing flow. You don't want to put that in your forecast. And the reason is because it's already embedded in your analysis in the discount rate. So in our project from a few slides ago, we had a discount rate of 12%. The cost of financing is already incorporated into that number, so we don't want to double count it by putting the specific interest cost outlay into our forecast. Finally, administrative allocations. The idea here, folks, is that you want to incorporate any incremental cost or benefit if you choose to flick on the project. So the question is, for example, if you choose to take on this project, do you need more people in the accounting office? Do you need more HR support? Do you need more middle-level management? And you may not be able to identify a specific impact on those overhead functions. But, as you might suspect, the bigger a company gets, the more admin that's required. It might not be linear, but what happens if you choose not to put any administrative allocation in? Then that cost never gets considered in any analysis of any project. So what tends to happen is that there's an administrative allocation that gets hung on the project associated with any analysis that's done. So if, for example, your company has shown that administrative costs represent roughly 5% of project's overall expenses, then that's going to be the cost that gets hung onto that project that you're going to have to put in there. If you can identify specific impacts, that's better. And so I put that in as a maybe because it's an open question. So let's go through a sample problem. You're considering a new product. It's going to cost $60,000 today to buy the machinery and equipment. It's going to be depreciated straight line to zero over 3 years. So that's going to be $20,000 per year. It's going to require inventory of $15,000 immediately to get the product to market next year. It's going to generate $100,000 of revenue each year for 3 years. Operating costs of $40,000. At the end of the 3 years, you'll sell or liquidate your existing inventory. You got a tax rate of 40% and a cost of funding of 11%. So how do you want to tackle this problem? I suggest you create 3 buckets. You specify the cash flows that occur to get the project up and running. You specify the cash flows that occur once the project starts generating revenue. And you specify the cash flows that occur when the project dies, the terminal cash flows. Each one of these things can be put into these buckets. So for example, the project's initial cash flows cost you $60,000 to buy the machinery and equipment, and it's going to cost you $15,000 in new inventory. So your total outlay in year 0, $75,000. What about for years 1 through 3? It's going to have a revenue impact of plus $100,000. You have costs, depreciation. Now, a couple slides ago, we said depreciation should not be incorporated into your analysis. That's true. So notice what I'm doing here. I'm subtracting it because it's a cost, and then I'm adding it back later. So notice depreciation is, in essence, not incorporated in this analysis. I'm subtracting out the $20,000 in one spot. I'm adding it back in another spot. So why do I need to do that at all? Because I want to understand the tax influence of that expense. Taxes are cash that we pay the government. And so I have to put depreciation expense in temporarily in order to understand the tax influence, and then I swipe it back out afterwards. So the tax influence is the only thing that remains. So notice this looks a lot like an income statement right here. And then we add back depreciation to get the project's overall cash flow. That's true. That In essence, this looks like an income statement plus depreciation. What's missing from this is perhaps some other pieces that are not part of the paragraph from the prior slide. So for example, if you had erosion or cannibalization, if you had side effects of this project, if you had, again, cannibalization, if you had an opportunity cost, that would go in here as well. In this simple example, we don't have those. But more practically speaking, we would want to put them in. So we've got our initial outflow of 75K. We've got our annual inflows of 44. Then what happens when the project dies? When the project dies, we're going to liquidate our inventory and we're going to recover that. So that's going to result in a cash inflow. If you're trying to think in your head about how to figure this out, just remember an increase in inventory corresponds with a decline in cash flow. There are some other net working capital items that we might need to consider as well. An increase in accounts receivable is associated with a decline in cash flow. An increase in accounts payable is associated with an increase in cash flow. So anything on the current assets side moves in the opposite direction of cash. Anything on the current liabilities side, so opposite direction, anything on the current liabilities side moves in the same direction as cash. And so when you're trying to think about and forecast the impact of a new project on your working capital, you're going to be projecting out increases and decreases in payables, receivables, inventory, and the like. And so you have to forecast out that impact on cash. In this project, we had inventory go up to $15,000 compared with what it was before, and it's held at $15K for 3 years, and then it goes back down in year 3 to 0. So we have two impacts. We have cash flow declining in year 0 when inventory goes up, and in year 3 we have cash flow improving as we liquidate that inventory. So the punchline, folks, is that if inventory goes up, cash flow goes down. If inventory goes down, cash flow goes up. For this project, in year 3, inventory goes down, therefore cash flow goes up. We would also need to incorporate any market value that we expect the machinery and equipment to have. Now, we know that the book value of the equipment is going to be 0. How do we know that? Because it's fully depreciated. It cost us $60,000. We depreciate $20,000 per year, so the book value is 0. It doesn't say anything in the paragraph about the market value, so I'm going to assume that that's 0 as well. So we have no appreciable cash flow associated with the machinery and the equipment. So the total terminal cash flow from the project is $15,000. Now, what happens in the event that you do think that the machinery and equipment is going to have value at the end of the project's life? So here, let's come up with a fictitious different end to this story. Let's say the market value of the equipment is projected to be $20,000. So you think you're going to sell it for $20,000. Well, that's cash that you're going to get in. The book value of that equipment is 0. Therefore, the government is going to force you to recognize a gain of $20,000. Again, that's market value minus book value. You're going to have to pay taxes on that gain. Taxes are 40% in this case, so taxes are going to be $8,000. So you're going to have two additional cash impacts that you would need to put into your analysis. The $20,000 check that you're going to get when you sell it, and the $8,000 check that you're going to write to the government. So the punchline is, if you sell the equipment for more than it's carried for on your books at the end of the project's life, you're going to have an inflow from the sale of the equipment, and you're going to have an outflow associated with the taxes that you pay. Let's say you have a different scenario where you sell the equipment for $20,000, but the book value of the equipment is $30,000. Again, that's not this example. This is just another made-up one. And in this case, you're still getting a check in for $20,000. So that's going to be a plus at the end of the project's life. But in this case, you have a book value loss of $10,000. So there's not going to be a tax liability associated with selling the equipment for $20,000 because you've incurred a book value loss. In fact, if you have other earnings, your tax impact might be positive. In other words, the book value loss can be applied against other earnings, so your taxes might go down by $4,000. And if your taxes go down by $4,000, that's a positive cash impact. So if you sell your equipment for a loss, you'll recognize two additional cash impacts. The check that you get from selling the equipment, and the reduction in taxes associated with a book value loss. Again, that's not the case here. In this case, we're not dealing with selling the equipment. We're going to let it rot. We're going to throw it away, or we're just going to use it for another project somewhere down the line. So we're going to ignore this. So what have we got at the end of this project? We've got a $75,000 outflow, followed by three $44,000 inflows. Terminal value also at year 3 of $15K. So your total cash flows are minus 75, plus 44, plus 44, plus 59. And if we evaluate them using payback, NPV, and IRR, and compare them against our cost of capital of, I don't remember, I think it was around 11%, we can see that the project is expected to create value, because this is greater than 0, that the IRR is greater than the cost of funding, that the payback appears to be short. So the decision is, yes, we like this project. It's one that we would seriously consider, and it might compare favorably against other projects that we're thinking about. So this is a summary of the capital budgeting process and the project analysis techniques that are employed by companies